At the start of the new year, we ask ourselves what will be important for investors in 2025. The focus will be on Donald Trump and his tariff policy. With regards to China, higher US tariffs are very likely because the US sees China as a political and military opponent. With regards to the European Union, tariffs are less likely. But the European Union also has a protectionist agenda and is relying too heavily on retaliation tariffs instead of pragmatically reaching a deal with Trump. In the end, US tariffs on European Union products are likely to rise somewhat. Investors will closely follow Trump's tariff policy because tariffs increase inflation. Depending on the extent of the tariff increases, US inflation could rise by up to 1 percentage point for a year. This limits the scope for Fed rate cuts. We expect only 2 more rate cuts to 4.0%. Germany will attract investor interest primarily because of federal elections on February 23rd. After 4 years of stagnating GDP, the country urgently needs a fresh start in economic policy. But potential coalition partners are unlikely to have a common understanding of how to improve the country's competitiveness, which has been eroding for years. We remain cautious with regards to Germany's economic outlook and expect the economy to stagnate again in 2025. For investors, ECB policy will continue to be a hot topic in 2025. The ECB is likely to cut its deposit rate from the current 3.0 to 2.0% this year. From the ECB's perspective, higher growth risks are likely to outweigh above target inflation. To sum up, also the Fed is likely to cut its rates only twice this year due to the increased inflation risks. This should not be a big burden for the equity markets, as Trump will improve the long-term growth prospects for the US economy through lower corporate taxes and deregulation. 25 is unlikely to be a bad year for equities, provided Trump does not implement his tariff threats from the election campaign one-to-one.